Hi, good evening, everyone. Thank you for coming in early. So I guess I'll start a little slightly earlier today because we have quite a number of you already here. Please let me know if at any point my voice become very muffled or if you can't hear me clearly. You can actually write it in the comment box. All right. So hope everyone had their dinner already. Maybe I'll just give you a bit of background of why I'm actually doing the webinar for this topic today. So previously, before I joined PhillipCapital, I was actually a banker in UOB. And basically what I did was also to help clients manage their portfolios, which range from insurance to ETF and stocks and bonds. So from there, my experience there has actually given me an insight into how some clients that might be a bit lost in how they want to allocate their portfolio. So some of them they just end up buying unit trust or ETF since there's a fund manager assigned to them. And after I came over to Phillip Securities, I also realized that there's also a different kind of clients that they actually do only stocks and then they don't do any other kind. So I felt that it might be good to actually give our clients here a better idea of how different kind of products that we offer can help to diversify your portfolio, not just in terms of a stocks portfolio, but an investment portfolio overall. So previously, before I worked in UOB, I was actually a teacher in MOE for about 4 years. And yeah, after that, I went to UOB for about a year plus, and now I'm here. So later on, we actually have a Q&A session. So if you have any questions, right, please reserve it for the end of the session. But definitely, if let's say you have any burning questions that you have to ask, by all means, please go ahead and just ask in the chat box. All right. So I would say today's webinar is more elementary. It's more, I would say it's something for beginning investors to make them, to give them a better idea of how they can diversify. Okay. All right. So, okay. So this is the outline for today. I'm first going to touch on what are the different products that make up a portfolio and how to find out what your risk profile is. After which we need to determine your time horizon for different kinds of products. And then we'll look at how to allocate, and obviously with the Q&A at the end. Okay, so what makes our portfolio? Some of my clients are actually surprised when I tell them that actually insurance is a kind of investment that is actually pretty good to have in a portfolio. Okay, the next one comes will be bonds, and then you have the ETF or unit trust, and lastly you have the stock. So I actually arrange them from left to right order according to how risky they are. But then again, of course, depending on the grade of a bond or the stock and share or the unit trust, definitely the risk within that category will vary. Obviously, you cannot compare an Apple share that is grade A, grade S to maybe a Semco Marine that is more of a penny share. Definitely I'll say the Apple share will be on a lower risk as compared to the penny shares that are higher risk because they are more volatile. But this is just a general scope. Okay. All right. So I will say that the general rule of thumb is for investment, right, is that the higher the risk, the better your returns. So for clients who don't like so much risk, they would generally go for the safer things like insurance or bonds or unit trust. But then again, we actually would not advise clients to put all your eggs in one basket and say that, oh, I only want to do stocks, I don't want to do bonds, or I only want to do unit trust. I feel that stocks are too risky. It's actually better to have a mix of each according to your different portfolio. So later on, I'm going to show you how to customize your portfolios according to your own preferences, your own risk profiles. So later on, it will actually be good if let's say you have your own piece of paper beside you and a pen. Okay. All right. So what is insurance? So I think a lot of us know that insurance is actually what you buy in the case something bad happens. But actually, what a lot of clients don't sometimes they don't really know is that actually insurance is classified into two types. One is protection, and the other one is actually endowment. So I'm going to be touching more on endowment because endowment is a very low risk, I would say, financial instrument that you actually can use that provide you with a steady income stream after a certain number of years. And this is actually something that I would recommend for all clients to have at least as your base. Okay. Or while we do offer insurance at Phillip Securities, I believe the ones that we have are actually more I think the ones we offer are more from China one. This one I'm not really sure because I don't work with the insurance department per se. But there's many different kind of insurance out there. It's up to you to find which one really suits you. And uh so usually if let's say you approach your financial wealth planner or you approach your insurance agent, you can ask them about what kind of endowment plans that they have. And then it'll be good if you can give them an a rough idea of like what time, around what age you plan to retire, so that they can actually do up a very nice plan for you where after retirement you receive a certain amount of money after for a certain amount of years. So this is actually the money that makes up the base of your portfolio, of your income, so that if touch wood, if anything happens when you do stocks and bonds, if let's say you really lose money, right, this is actually a sum of money that you will never lose and it's safe. I would say that the return on this is low, mm, just good enough to beat inflation. Inflation in Singapore is about 2 to 3%. Depending on the kind insurance plan that you get, probably the kind of returns you're looking at maybe 4%, 5%. So definitely the rate of growth most of the time will be higher than uh, if inflation itself, but don't expect a lot of returns here. Okay, and the risk factor here I would say that is potential loss of premiums if let's say you terminate your plan early or you plan to cash out early. The liquidity for this, which means how liquid your money is, right, I would say it's actually medium because there's actually plans where you can put down $300 a month, $400 a month, according to how comfortable you are. For clients who have a large sum of money, then they actually can go for those kind of single premium. Single premium means you one shot put down maybe 20, 30,000. Some of them can even put 100K, 200K. Okay, so there's a lot of flexibility of what kind of insurance that you want to choose. But I'm not selling insurance here. I'm actually just giving a general idea. Okay, so the next one that I'm gonna explain to you about is actually bonds. So bonds is actually basically when you are lending money to government or companies. So one example government bonds, right, is the Singapore Saving Bond. So Singapore Saving Bond, I would say, is a more liquid kind of bond where there's no minimum down payment, minimum lockdown period as compared to most kind of bonds. Okay, so for normal bonds, right, usually it's actually a long-term investment product. So why some clients like it is that some of them will actually give you dividends every now and then. Okay, but if let's say you actually invest in corporate bonds, right, it's a lump sum payment that will actually reduce your liquidity. Okay, so I would say before you put down a lump sum of money for bonds, right? If let's say you have about maybe 200K in your savings, definitely I would not recommend you to put 150K directly inside. You might maybe want to consider endowments that maybe you can do like a monthly saving kind of plan. Okay, so the risk for bonds, right, is the potential loss of principal. For me, as I would say when I manage my clients' accounts last time and even now, I would always advise clients to look at the worst case scenario. I would say that a lot of investors, when they invest, they look at the success stories of other people. They're like saying that, oh, Mr. Tan, my friend that I know, he went to buy this share and then he earned a lot of money. But and then people start to do mirror trades. They see their friend buy what, they also buy what. But at the same time, with I would say some of my clients, they fail to consider a worst case scenario. So I'm more of a prudent kind of investor. So for me, I'll always advise my clients to look at the risk factor, which is why in every single kind of slide when I introduce you all these kind of different financial instruments, I will always inform you of what is the risk factor. So for example, depending on the kind of bond that you hold, if let's say you hold an unsecured bond, and if the company goes under, then you're actually the last on the list, right, to actually be able to get your money back. So for example, Robinsons recently just went under. If let's say you happen to hold on to an unsecured bond from Robinson, then it's very unlikely that you will see your money back. Okay, but for companies that are actually doing very well, you might actually see an appreciation in the amount of investment you from that you have actually invested at the start. Okay. All right, next one I'll be touching on is ETF. So ETF is like a bundle. It's like a hamper of goodies because you can't decide which is better. And it usually is to wait sorry. Hi, can everyone hear me? Sorry, my speaker just died. Can everyone hear me? Testing 1, 2, 3. Hello, testing 1, 2, 3. Can everyone hear me? Hello? Okay, great. Thank you. All right, so sorry because my speaker just died, so I'm actually relying on the computer speaker now. Okay, so for ETF, right, it's like a bundle. Like I say, it's like a gift hamper because you can't decide on what you want, right? So usually, before you buy ETF, right, I actually advise you to look at what is actually inside. For example, the most recent OCBC Lion, the OCBC Hang Seng that ETF is actually the tech ETF is actually a bundle of Hong Kong's 30 top companies for tech and healthcare. So some clients would just buy because it's fear of missing out. They see people buy, then they just follow. But what I always recommend my clients to do is to look at the list of what is actually inside. So for example, it's actually look at the top 10 the highest percentage where they're actually going to put your money into, right? Most of it is like Alibaba, Meituan, Ali Health, Tencent. So make sure that these 10 are companies that look at the biggest percentage are companies that actually believe in that you will do well. If not, it might actually be a better idea to invest in the company separately, like buy the stocks by itself, like just buy maybe Meituan shares or maybe just buy Tencent shares. If you feel that maybe Alibaba shares might not be going up anytime soon. But one good thing about an ETF is that there's a lot of diversification. So it actually hedges your investment. For example, maybe inside one ETF, they might have a component that invests in healthcare. Another one might invest in invest in let's say maybe the defense. Maybe one is in the healthcare sector, the other one is maybe in the defense or wartime, or like buy those that sell military equipment. So in this sense, right, if let's say at times of war, then obviously the one that's the company that sell military equipment will do better. Okay, and then when you hedge yourself against this kind of companies inside ETF, right, then I would say that when things turn sour during a pandemic, then at least some of your shares it will not be so badly impacted. Okay, so the risk factor is if let's say like for example coronavirus hit, and then your ETF very sway happen to be a bundle of maybe restaurants and airline companies, then that diversification won't work. Okay, I would say that the liquidity for ETF is actually medium because you can trade it anytime you want, like stocks and bonds. There's actually no lockup period as well. Okay, so the last one that I'm going to touch on, the very basic ones, is actually the stocks that I'm sure all of us have already come in contact with. the range for stocks and bonds is usually grade S to grade C. So S bonds are the ones that graded the highest, which has the least, I would say the least risk of it going under. And grade C shares are more of like your penny shares that you trade on a day-to-day basis that clients like to play contra and play on the volatility. Okay, so for, I would say, from experience, right, clients who are older, they usually prefer companies like DBS and OCBC and UOB, or these kind of major banks, because they always give dividends. So the good thing about shares is that there's a lot of liquidity for flexibility and customization. Like there's even long and short options for you to do for you to play with the market. So I will say that although stocks, right, is on the higher side of the risk spectrum, it offers you a flexibility that our endowment plans and bonds cannot give. And you actually are spoiled for choice in the market, because not only are you able to vary what kind of bond you buy, you can even choose whether you want to short sell or do over the counter, or maybe you want to play CFDs. A lot of variations that you can customize to suit your needs. Okay. All right. So actually, I found this very nice cheat sheet from Seedly that we actually can refer to. So I'm actually not really touching on cryptocurrencies because I know that recently the Singapore market has opened up for cryptocurrencies, but I would say it will be good if you really want to invest in cryptocurrencies, go and do some reading, because Bitcoin, all these, and cryptocurrencies can be pretty volatile. Okay, so I would actually not really encourage clients to just leave their money inside the bank, because the rate of return you get on the bank is very, very bad. Previously, for someone who has worked in a bank, is really bad, especially during COVID. I know that the rates are dropping even more. Like even if you put your money inside our money market fund, the returns might be even better than putting inside some of the bank accounts. Yeah, for normal bank accounts, those with no special interest rate, if I'm not wrong, your return is only 0.05%. It's not even 0.5, it's 0.05%. So if you hedge that, if you go and compare that against inflation, right, you're actually losing money when you put money idle inside the bank. Okay, so when we come to investing, right, there's always different kind of perspectives. Okay, so different clients will, when I was previously working in UOB, I have clients telling me that, Athena, I don't believe in insurance at all. I don't want insurance, recommend me something else. I also have clients come tell me, wow, Athena, I have many insurance already, and now I got spare cash, I want to buy more. So it basically is just that, one man's meat is another man's poison. From our different life experiences, definitely we will want different kind of investment products. Okay, so how do we exactly know what suits whom? So if let's say you have someone who manages your account, how does the person know what suits you, and how do you know what you prefer? So on the topic, right, this is actually touching on the topic of risk profile. Okay, because different people, they have different risk profile at different stages of life. So for example, when I just graduated, I'm single, I don't have much income, but at the same time, I don't have much commitments either. Maybe at the point of time, I haven't even got maybe if I'm a guy, I haven't even got a girlfriend yet. Then you're thinking, still a long way to marriage. Then definitely, you'll be more adventurous, and then you'll be more willing to do something with your money. Okay, as compared to maybe someone in their 40s, 30s and 40s who actually have already started a family, I would say that the risk profile, they are less, they would choose to be more safe, they are more conservative and less risky, because they have a lot more commitments. The commitment becomes very high, and the disposable income, money they actually can spend, becomes very low. Because when your paycheck comes in, you have to pay for bills, you have to pay for your children's tuition, you have to pay for books, they have to pay for the maid, have to pay for the car, have to pay for house loans, a lot of things to pay already. Okay, so obviously then these people, they are more prudent once they put money into an investment, if let's say you put in stocks, then they might not have as much liquidity as they would have as compared to when they just graduated, because you never know when something will happen and you will need the money urgently. Okay, so depending on your how your characteristic as a person, your character as a person, and which stage of your life you are at, we all have different risk profiles. So for example, like for me, I'm probably in the want to buy a house down there. I don't have much commitment. My disposable income is definitely, I would say, higher because I don't have I don't have any loans. So I'm actually at a stage where I have more liquidity to play with my money and move funds here and there to make full use of it. Okay, so this is actually a summary of the chart just now. If you feel that if you feel that this will be beneficial, you can always take a picture, or you can go to seedly.sg to go and take a closer look. I actually find that charts and infograph quite informative. Okay, so at Phillip Securities, we have something slightly more comprehensive. So we actually do have a questionnaire of a few questions that it takes about less than 5 minutes for you to complete. And so okay, I will show you the scan this one later, but basically, right, after you have done this risk profile assessment, right, it will actually show you your risk tolerance, and it will show you what kind of liquidity that you need. All right, so I'm just going to leave here for about a minute for everyone to scan, or if the scanning doesn't work, you can always key in the link manually. All right, so I'm just going to leave this here for about I would say 3 minutes. I'll put a timer for 3 minutes for everyone to finish answering the questions, and then we can take a look at your risk profile together. All right, okay, I'll leave all of you to it and mute myself temporarily. Oops. Okay, can. All right. 3 minutes are up. For those who still might be doing, maybe I answer two of the questions that I already see on the Q&A. Anyway, I revised my speaker already, so I hope everyone can hear me. Oh, stuck at question 9. System won't go forward. Maybe you try restarting your browser. Maybe you try restarting your browser or just using on your phone. Okay, while we are waiting for some of our attendees, maybe I just answer Timothy's question on whether CPF can replace endowment as part of portfolio education. Okay, you have to understand that CPF, right? There's a lot of government restrictions on when you can actually withdraw. And if let's say you are 30 now, like 20, 30 years down the road, you're not going to be sure what kind of government legislation there is. Okay, so there's always the uncertainty that government might choose pattern and change and then tell you that, oh, you only can do withdraw after that, or only you can withdraw after minimum sum that has been raised higher. So there's always certain restrictions that are placed. But for endowment plan, right, as long as the money has been there for a sufficient number of years as per your contract, then there shouldn't be any issues. Okay, so uh okay, let me just finish the question first for endowments, then let me get back to those who are stuck. Okay, so for endowments, right, it actually give you the power to have more control over, when you're older, how you want to spend the money. For example, some clients, they maybe already, they want to have those kind of like every month give you a certain income flow, like to supplement the CPF. And in the event that something happened, maybe they urgently need money for certain life any kind of life events, they can always choose to withdraw the maximum, the full sum out that CPF might not give you the flexibility to. Okay, so let's go back to those who actually have problems with question 9. Can I check other than Kit Leong and Jo Chia, who else have issues? Okay, anyone else facing the issues? Okay, Wei Wong also raised hand, I saw. Okay, wait, I'm going to the now site can't be reached. Oh no. Okay, that's not good. Can't get past the first next. Okay, I have 4 people who raise hands. So I'm guessing that it's at least 4 people who have problems with this. Too many user system hang. I think when they designed this, they didn't expect that so many of us will be using this at the same time. When I tried it the other day, it was actually working fine. Okay. Wow, okay, it's actually pretty bad. I can't even get past the first page. Oh, no issue on mobile. Okay, so maybe everyone try on your phone. Thank you, Justin, for letting us know. So I'm just gonna give everyone a bit more time. Oh, Kit Leong's on the phone but also cannot. Okay, can come, let me try. I tried my phone. Just now I tried my laptop also. Okay, this one I'll definitely feedback to my technician. Okay, I think I also hang. Okay, let me see if I can find another risk profile as questionnaire online. Okay, can. I found another one that is by website not affiliated to us. So you can try doing this as a reference. Okay, wait, let me get the link for you. Okay, on the chat link, on the chat box, I've just sent a link for a different kind of risk profile assessment. So hopefully you should be able to assess this one. This one might not be from Phillip Securities, but it should serve the same purpose to at least tell you what your risk profile is. Okay, I'm going to try this myself now also. Okay, good. It will usually tell you whether you are moderately conservative or risky. Okay, so if anyone else has any issues, please let me know. Yeah, I put it on it's in the link, right? Everyone can see the link. Is investsmartsc.my/my risk profile. Eh? Sorry, I don't know why when I posted people cannot see. But my colleague Mike has actually posted. Can everyone see the other link? Okay, can. Thank you. Okay, I'll give everyone's about maybe 1 to 2 more minutes. Okay, is anyone still not done yet and require assistance? Please either raise your hands or let me know through the chat box. If not, I'm going to continue. Okay, going once, going twice, going thrice. Okay, I'm going to assume that everyone is done. So let's move on. I hope that everyone has their risk profile already. So whenever I would say make an investment, right, it's actually a MAS regulation to actually let the client do a risk profile assessment first. So I'm sure for quite a number of you, right, this might not be the first time you actually do a risk profile assessment before. Okay, so if let's say you have actually been able to do it on our Phillip Smart portfolio, right, then you'll be able to see your risk tolerance. Is it low risk and what kind of liquidity need? And they actually have this recommendation for what kind of things you should invest in. Okay, so this one, because it's more tied to our global markets, right? So for the allocation, this part you actually can take it for reference, but I'm not going to touch on what kind of markets you should be investing in today. It's rather on what kind of investment products. Okay. All right. So the next one I'm going to touch on after time horizon, right? Is after risk profile is actually time horizon. So according to different kind of clients and different investors, they have different time horizon. Some clients like to do inter-day trades, 1 day trade 20, or maybe then there's also clients who buy already and then within the whole year they don't trade. They just wait for stock split or they wait until the share go up. Okay, so because of this huge spectrum, it's always good to ask first before you invest. What is the purpose behind me buying this? For example, I have clients who actually buy ETF because they want to for retirement. They feel that, okay, this ETF, I believe that after 5 years, right, by the time I'm 65, it can provide me with good dividends and good income. Then if let's say I really need emergency cash, I can sell it away. So my advice for clients usually is, before you buy a certain kind of share, or you buy bonds, or you buy endowment, always ask what's the purpose. For example, I have actually one endowment, I think one or two endowment plans going on. One of the endowment plans is for me when I retire. Another one is actually more for short-term one, where in the next 10 years, for example, let's say my kids want to go university or whatever, then that's money that actually I can touch. Okay. So when we look at time horizon, right, we have different people in different stages of life wanting different things. For example, a single guy who just came out of university, his dream will be to buy a car. And then we have those who are planning, who already got a girlfriend, want to get married, then they're actually thinking about, okay, I want to save for a house. And those with kids who just give birth already, they'll be thinking, oh no, my child is going to be going to have a big ticket spending by the time they go to university, so they have to start planning for that. We have clients who already, their kids go to university and then empty nest, and next thing on their mind is the retirement. We have clients who just want spare cash, or clients who just want to save for a rainy day. So according to your risk profile and what you want to save for, your portfolio can vary from person to person. Okay, so now, right, I would actually need all of you to be a bit more, I'll say, engaged. I need help to take out pen and paper and some positivity. Is actually to help you to plan out your life goal timeline. It might be a bit it might be daunting, a bit daunting for clients when we just graduated from university, because like, I just graduated, I'm not sure what's going to happen in my next stage of my life. But it's all right. You can just think of, okay, let's say I'm single now, don't have girlfriend, don't have boyfriend, also never mind. You can say, okay, in the next 5 years, I plan to get married. Then after another 5 more years, after maybe two more years, 3 more years, you plan to have a baby. Then from there, you plan further on. Okay, baby. After that, 21 years old later, if 21 years old later, if it's a boy, need to go university. So basically, it's planning out the kind of life you envision yourself in, okay, on a timeline. And I'm going to have a demo here, how it can actually look like. Let's see. How do I write here? Okay, wait. Does Zoom actually allow me to? Okay, no. Okay, I'm actually not able to draw. Okay, I'm not able to draw to show you, but this is how your timeline should look like. So starting from the age that you are now to the age that you feel that you don't need money anymore. So this year I'm 28. Okay, so maybe after that, about maybe 30, I plan to get married. And as you realize, right, all these I put in red color because the expenses. Okay, so for expenses, I put them down, and and I'll always put, how old I am, and then what I plan to do. So this is kind of like your life plan. So I will say that the purpose for clients to do this is to be conscious of why they're investing and what they're investing for, instead of just, oh, I heard that share is good, my friend make money, I also want to buy. Okay, so I'm going to give everyone about maybe 5 minutes to plan this out. I would also I would say that the ones that I jotted down are more of the major life goals. But if let's say you have other things that you want to buy car, go ahead, put it inside. You want to maybe buy a second condo, or clients who want to be able to retire early at 50 and then travel the world. So different clients will have different kind of timelines. It's more of what you envision for yourself and for your family in future. And if let's say maybe I'm going to be a bit more realistic here. Let's say your family has a history of certain kind of diseases, you might want to plan a bit more for medical bills in future. Or maybe you see that your child is very smart now, then you might want to aim child goes to do masters, child goes to do PhD. So basically, I would say is to write down the major life events that you see yourself having in your lifetime. Obviously, life is not going to go according to plan, but it's better to have an idea and a certain goal to work towards than not knowing why you're investing. Okay, for clients who are slightly faster, okay, you actually can move on to the next part. Okay, the next part will actually be using a blue pen, or if let's say you don't have a blue pen, then any other color, drawing on top about your inflows. Your outflows, which means your expenditures, are below, and then your inflows will be on top. What is your planning? So for example, I'm 28 now, I have endowment plan, so by the time my child go to university, right, my endowment plan mature, then university fees I don't have to care already. I save about $300-400 a month, and by the time my child go to university, then I don't have to take loans, or my child don't have to take loans, or these kind of things. And for maybe now, the time gap is shorter. For the short term, I buy some shares, I buy some bonds, and by the time I want to get married or sell house, buy a house, then I sell some shares. So it's basically what you have done already. So this what you write, right, is what you have done already. Okay, if you have any questions, feel free to raise your hands or write in the Q&A or the chat box. You can also put in things like inheritance. For example, if let's say you know that your parents are really going to leave you with a sum of money, then go ahead. No, you're never too old to participate. Like if let's say you are 60, you can plan for after retirement. I'm sure within the next few years, you already have some things maturing, maybe some endowment plans maturing. Actually, if you are 60 and 65, 60 and above, I kind of envy you because you're already done with all the hard parts in life. You're just waiting to retire and waiting for the money to come in. So you can, plan, you can actually write in the plan, next year I want to go where to travel. Then 2 years later, what I want to do. Oh, everything is in stocks. Or everything is in stocks. Okay, then that's actually good. It's actually good to have liquidity, but just make sure you're covered by insurance in case anything happens medically. Yeah, so last time when I was a banker at UOB, right, when I actually do this for my clients, a lot of them realize that they want a lot of things in life, but they don't know where the money is coming from. So even if let's say you're a client that you don't want to do stocks, or maybe you don't want to do insurance, or maybe you just want to learn about how to plan financially, this time is actually a good tool that you can use to look at where you are and what you need to do. So some of you might have already endowment plans in place, right? So can go and check your agent. In my plan, when I can save money, then you can write inside your this timeline. So it gives you a sense of security. Like, okay, when I'm 51 years old, I don't need to worry, it's already taken care of. Okay, so for the faster clients, okay, the next step is actually to identify your gaps. For example, for me, I will see that my gap is after buy house, then have baby, give birth, very expensive. Go hospital, go private or go public. If no money, have to go public, and then go and be the new the doctors that just graduated the lab rat and let them go be their first few patients to let them do testing on you. If let's say have money, then can go private one to get more experienced doctors. So, and then maybe my other gap would be, after when I retire at maybe 65, I get 100K bond that mature. But then the problem is, how long can that 100K last for me? If let's say like for example, my family has a history of heart problems. If let's say I have heart problems in the future, 100K very fast to blow through one. So that is where I need to make sure that I'm covered by insurance, or I have other sources of income coming to me to I would say to cushion me against all these kind of unexpected costs. Okay, can I continue? Does anyone need more time? Okay, going once, going twice. Okay, I'm going to continue. I think everyone here should get a rough idea of how the timeline is supposed to be planned financially. Okay, so usually, how do you allocate? So with all this, so I came up with this table that you can take a picture for reference. So with the different investments and whatever, right? It's always good to take note of what the risk level is, and then look at your portfolio percentage at the side, right? And then write what's the purpose for this. Usually for endowment plan, it's always child's education and retirement. Bonds is always retirement extra savings. Stocks, right, which are can be more flexible and short term. They can be for a car or for a house, or maybe for your marriage or your wedding. Okay, don't worry, you're going to see this table again later. Okay, so now that you already know your risk preference and you kind of know how much liquidity you need and you've identified your financial gaps, we are going to look at some examples. But because I cannot use real clients examples due to PDPA, we are going to look at our favorite Phua Chu Kang family. Because recently I've been watching a lot of Phua Chu Kang because they're available on Netflix. So it's like reliving my childhood. So when you look at Phua Chu Kang himself, he's a contractor. His needs are like our everyday, like middle-aged working man. The last episode I watched, he actually had a new baby. Okay, so he also have a Tai wife, Rosie, to support. So what would you say is his risk profile and liquidity based on his current life stage of being the owner of his own company? Okay, you can actually put in your replies in the chat box. How will you say Phua Chu Kang, his risk profile and liquidity is like? Is he a risk? If let's say he were to invest, will he be a risky investor, or would he be somewhat more conservative, or just middle? Or in terms of liquidity, will he like need a lot of money? Or will he like, it's okay, don't need so much liquid funds, he can throw everything into one kind of investment? Okay, Timothy says conservative. Then what about liquidity? Does he actually need a lot of money, like free flow money on hand? Middle. Yes, correct. Need some liquidity. Yes. Thank you, Timothy and Kit Leong. So I would say that for Phua Chu Kang, right, he is actually more of a middle kind of risk profile, because although he's not young, he's not that old either. So he's at a comfortable stage in life, right, where he has his company going on for him. And if let's say the baby was not born yet, right, then maybe he can be more risky. But with the baby around, right, he will be more of a mid low range kind of more towards the conservative side, because he need to start ensuring that he has enough money for diapers, enough money to buy milk powder, enough money to buy baby clothes. All these are a lot of expenses, correct? So for someone like him in that stage of life, his portfolio would probably look something like this, where it's more of an even, more even, but as you can see, stocks, the higher one is about 30%. And then the more safer ones make up about maybe 60-70% around there. Okay. So the next one, so this is actually more of a middle-aged profile. What about Phua Chu Kang's mother? I know the images are a bit blurry because it's actually really hard to find images of them online because it's such a long ago TV series. Okay, so I don't know if you remember her name. She's actually Phua Ahmad. She's retired already. She has no more life commitments. She just stay in the house, make ice kacang for her children when she's free. And she doesn't spend a lot. As you can see from the way she dresses, she actually lives a very frugal lifestyle. So what will you say is her risk and liquidity? Does she need a lot of liquid funds? Would she be a risk account investor? Low risk, small liquid. Yes, correct. Because she doesn't spend that much. So actually she doesn't need a lot of money. But at the same time, because she's older already, right? She actually will need more money on hand just in case something happens and she need to pay for medical bills. Yes, correct. Very good. She don't need to take unnecessary risks because she's living together with Phua Chu Kang and her two sons. Anything happen, they will take care of her. Correct. So she's actually, I would say, the one of the more conservative kind of investor, where I will only put 10% allocation in stocks, and that is only when she got spare cash on hand. Okay, anything else, I actually would say it would be better if she put in an endowment plan for emergency or medical bills, or stocks and or bonds or ETF, for extra savings, things that are less risky. So overall, right, the risk profile of this portfolio, right, would be slightly on the will be on the safer side. I cannot say entirely no risk, but it's on the safer side where she doesn't need to be gung ho and put more in stocks. Don't need to be so aggressive anymore because she's already at a very comfortable stage in life. A little bit for insurance. Actually, right, do you know that you can actually buy insurance up until the age of 60 or 65? Depend on what kind of insurance. There are some clients who are about 60, before the age of 60 or 62. I cannot remember already. I'm so sorry because I don't sell insurance. There's a specific age where you can. I'm actually not sure how old Phua Ahmad is, but if you are not yet 65, not yet 63, right, you actually still can buy endowments. And you can buy this kind of like very short term ones, like 5 years, 7 years, 10 years, 15 years. Depend, like, I have this client last time when I was at UOB, he was like 60 already, but he had a newborn baby girl who is actually his daughter. So he got like 15, 20, he got an 18-year endowment plan just for her where he saved like $1,000 every month. So it's really based on your life needs. That's actually also a good idea. Top up your CPF retirements. But what my colleague and I we explained earlier on, right? When you top up CPF retirement, there is less control over what you want to do with your money. Whereas endowments, you have more freedom over what you want to do with your money because it's not subject to government regulation. Okay, so those who are not 60, 65, I'm actually really not sure about the age. I'm sorry, but you can check with an insurance agent. If let's say you have not passed a certain age, right, you're actually still eligible to buy endowment plans. Okay, so the last age group that I'll be talking about is actually Aloysius Phua. I circled him out here because I really cannot find a decent picture of him online. I'm so sorry about this. Okay, so he's in his early 20s, just finished NS, finished university, came to workforce, maybe looking for a girlfriend. Very typical carefree Singapore young adult. No loans, no commitment, handphone, maybe just started to pay the handphone bills only, still living with the parents. So definitely, his risk, he's actually in a position to take up a lot more risk than his grandmother or Pachukang, his uncle. But I would say the problem with his liquidity is that his funds are not so liquid because he doesn't have that much income. Okay. All right. So this would be something that his profile will be like. Okay, so he can actually take more risk and invest more aggressively in stocks, maybe even up to 70%. And then the rest maybe endowment plan, maybe he do like $100 a month. Even 50, even 70, 81 also have, I think. Then not so much on bonds, because he doesn't really need a steady income stream yet. So for I would say the youngsters, they actually good position to be in because no life commitments yet. Unless you are the kind of youngsters that come from a more humble family and then you need to work a lot to support your family, then it will be different. Okay, so this is just the average Singaporean who just graduated. All right, so I've actually come to the end of my presentation. These are actually the references I have used. So just a bit of information, if you don't have an account with us, you can open your account in 5 minutes. I opened for my friend before. As far as you have used my info, right, it really only takes such a short while. Okay, so right now we have this ongoing promotion. If you open a Cash Plus account, you get 5 free trades for new clients. And the brokerage for the USD market can be as low as $6.88 flat, regardless of how big your purchase is. That means if you buy like even $1 million worth of US shares, your contract, the brokerage is only still $6.88. Okay, so this is the brokerage for the Cash Plus account. You can take a look on our website. For I would say younger clients who don't have that much capital, right, you can actually look at CFD, because CFD is a leverage product that actually allows clients to borrow and leverage their funds to be able to to invest more than the initial capital that they have. Okay, show my references again. Okay, can the references are actually just the Seedly the Seedly info sheets that you saw the other day, just now, you know, where it shows the different ages, what kind of risk profile. And the other one, the needs in life stages, is actually the chart. The chart where it shows commitment in life and the disposable income. Okay. Okay, so when you open an account, definitely you need to do CKA, because we need to actually see whether you're eligible to trade CFD. When you open an account, we also will do a risk profile assessment review to see what kind of investor you are. This is according to our MAS regulation as well. Okay. All right, so this is our disclaimer. And there's actually a QR code. If you have any feedback, please feel free to scan. Let me know if maybe I talk too fast. That's my bad habit sometimes. Or if maybe you found my webinar today to be interesting and helpful. It'll be good to know also how I can improve on myself for future webinars. For clients who have actually opened your account online with us, let's say you're under TQ or TF, TF2, where I'm actually the online brokerage team that is actually in charge of you, where we manage your accounts and place trades for you. I also do a bit of customer service where to help clients every day when they come to us with their query. So my number is here, and there's also my my personal work email. If you have any questions, you can always feel free to email me. Okay, and now we can start on our Q&A. Okay, so I have not answered the second question. Instead of bonds, wouldn't bond funds be better? Spread the risk of a single bond. Yes, I would say that no matter what kind of investment product you are investing in, right, it'll always be good to diversify and invest in a basket of things. But just to make sure that you know what investing, please go and check out what is exactly inside the basket. Don't be like those people who go to maybe Yuan Sang, they see the hamper, wow, very nice, look good, then they buy back. After that, they realize that, oh, this thing I don't want, that thing I don't eat. Then it might have been a better idea to buy those things separately. Okay, so not all bundled things are good. Make sure that it's something that you believe in before you buy. Okay. How much do we charge recording? No. This is a service. You're our client. I'm your broker. So obviously we don't charge. I would say only the telecos will charge. If let's say you are not on a free outgoing plan. Depends on your phone plan. So only our telecos will charge. We are not going to charge for our advice. So we have clients who call into the hotline, but who call to ask, what are shares good to buy, what are shares to look out for, why is this happening to my account, what kind of different accounts is good for me. So different kind of client queries. Will do our best to pick up the call. Sometimes the call might get jammed or a lot of clients calling in, but if you email us, definitely we will get back to you. I make it a duty to clear my emails properly every day before I go off work. A bit OCD lah, yeah. So if let's say you try calling in but the phone is jammed, if you email me, definitely I'll get back to you. And email is definitely free. Yeah. Okay. Any more questions? Okay, so if there are no more questions, then thank you everyone for your 1 hour today. I'm glad to have ended on time at 8:30 so that those who have not had dinner can go and have their dinner. And I hope that I have given you a better idea about how you want to invest, because I have clients who call me that they want to buy UG Healthcare or MedTech, which is a restrictive counter. And then when I told them there's restrictive counter, that's why I have to buy through me, they come and ask me, oh, what is this company doing? What kind of stock is it? And I get very scared by these kind of clients, because it's not that we don't want to earn your business, it's not that we don't want your brokerage, but I prefer to educate my clients on what they are buying before they place a trade. So sometimes it's really not about the brokerage, but more about making informed decisions where you know what you're buying and you're comfortable with what you're buying. Okay. All right, so that's all for today. Thank you so much for the feedback. If you have any feedback for me to improve, please let me know. If not, I'm going to call it a day. All right, have a Merry Christmas, everyone, and a Happy New Year in advance. Okay.